Senate Committee on Banking, Housing, and Urban Affairs will come to order. Welcome to the witnesses and committee members. We know that most Americans want the same things: a safe, affordable place to call home, a good-paying job, a strong, stable government which they can trust. Our democratic institutions are only as strong as the people who empower them. Our economy works best when we have a free and fair democracy in which everyone can live lives with dignity. For too long, many of these dreams have felt out of reach. Working families struggle to pay for groceries, to keep gas in their car, to keep a roof over their heads. The cost of living and raising kids continues to rise. Democrats are listening and have delivered for the American people. We've passed legislation to lower prescription drug costs. We helped families stay in their homes during the height of the pandemic. We made investments in public transit and our nation's infrastructure. For the first time in generations, we focused on communities that our governments turned their back on, especially, for instance, in my state, it's state government. Now we're tackling inflation by taking on corporate power and consolidation and reducing our dependence on foreign oil. We do that while creating good-paying manufacturing jobs at home. These jobs, making semiconductors, electric vehicles, solar panels, are the jobs of the future. These jobs will go to Americans because we passed the CHIPS Act, the Inflation Reduction Act, and the bipartisan infrastructure law with strong Buy America provisions that Senator Portman and I worked on. And we see results. Our economic recovery has been strong. Over the past 2 years, many Americans have built up more in savings. We've seen robust job growth. For the first time in decades, we've seen wage gains. Just last week, we began to see signs that inflation is starting to cool. Banks and credit unions are doing well thanks for the protections we put in place in Dodd-Frank and because of the support that Congress and regulators provided during the pandemic. Too many big corporations, though, have taken advantage of market concentration, jacking up consumer prices, earning higher and higher profits. As my colleague Senator Reid has pointed out, the biggest banks that benefit from higher interest rates today are not passing on those benefits to their customers, again penalizing Americans who are trying to build up savings. Workers and small businesses already struggling under the weight of inflation shouldn't get hit with exorbitant bank fees, shouldn't lose their money on a crypto scam, shouldn't have to worry that their savings will disappear overnight if a mismanaged bank or credit union fails. None of us want a scenario where risky bets on Wall Street crash the economy again. That's why it's so important we have financial watchdogs like the four of you empowered to look out for Main Street, helping more Americans hold on to hard-earned money at a time when they need it most. Banking and credit union regulators are independent agencies that protect consumers, make sure banks and credit unions are safe and strong. Their independence, your independence, matters. It makes for a more stable financial system. It's essential for the entire economy. Our witnesses today all have decades of banking and credit union regulatory experience. They spent careers serving the public and protecting consumers, making sure our banking and credit union system works for Main Street, not just for Wall Street. That's exactly what they continue to do today. They're modernizing and strengthening an important civil rights law that will spur new investment in neighborhoods and communities that have been left on their own. Thank you for that. They've taken a closer look at overdraft, non-sufficient funds, and other gotcha fees at banks and credit unions to make sure customers are treated fairly and that these fee programs don't raise safety and soundness concerns. Thank you for that. They're taking a fresh look at the bank merger approval process so we don't continue this rubber stamp consolidation, which has big consequences for local communities. Too often big banks merge and close branches, leaving rural towns and urban communities without a bank. They're revisiting the financial system's safeguards that protect us from risks at big foreign banks, making sure bank failures don't leave taxpayers holding the bag. It's important to remember the super regional banks of today are hundreds of billions of dollars larger than the largest banks that failed during the financial crisis. Our financial regulators know we need strong capital requirements so banks and credit unions can continue to lend and invest in communities in good times and bad. They're also overseeing the formation of new institutions that serve communities that often get left behind. Just last week, NCUA chartered a new faith-based credit union. FDIC recently approved the first mutual bank in 50 years, which will pave the way for more in Ohio and across the country. All the agencies are working together to foster new banks and credit unions and support the work of MDIs and CDFIs in their communities. At the same time, Our regulators are looking out for risks on the horizon, the effects of climate change, the rise in crypto assets, the risks from shadow banks, the constant threat of cyber attacks. They're working with banking and credit union industry to prepare for climate-related risks and bolster cybersecurity protections as criminals become more sophisticated and geopolitical threats increase. They've stepped up to protect depositors and consumers when crypto firms mislead them into thinking their money is safe when it isn't. But we must stay vigilant and empower regulators with the tools to combat these growing risks. Data breaches at banks and credit unions happen too often, threatening customer data and exposing our financial system to vulnerability. That's why we need to pass the bipartisan Improving Cybersecurity of Credit Unions Act led by Senator Ossoff and Lummis and Warner. We need to make sure that banks and credit unions can partner with third parties in a way that allow banks to stay competitive without putting consumer money at risk. We can't let big tech companies and risky shadow banks play by different rules because of special loopholes. All these things will help strengthen our banking and credit union system for its core mission, serving Main Street and workers and families. When workers have more power in the economy, they find better paying jobs. We have a stronger labor market. That helps credit unions, which added over 5 million new members over the past year. It drives down the number of households without a bank account, which dropped to record lows in 2021. When government's on the side of working families, more Americans save money, more Americans build wealth, more Americans start small businesses, more Americans participate in our economy. Our financial regulators have answered that call. Thank you for that. I'll continue to work with them to make sure our banking and credit union system works for everyone. Before I conclude my remarks, I want to thank the witnesses again for being here, especially congratulate Marty Gruenberg on being nominated by President Biden to be chair of the FDIC. Marty's well-respected, seasoned regulator who's worked to protect consumers and preserve confidence in our banking system, played an instrumental role in helping implement many Dodd-Frank reforms. With his experienced leadership, I have no doubt that FDIC can continue to address risks in our financial system and increase access to affordable financial services and ensure that banks honor their commitment to communities through the CRA. This committee looks forward to holding a nominations hearing in the next few weeks for Marty and other FDIC nominees. Senator Toomey.
Thank you, Mr. Chairman, and welcome to our witnesses. Throughout this Congress, I've warned about the politicization of the financial regulation. Some bank regulators are increasingly straying outside of their mandates into politically contentious issues. Take global warming, for instance. In September, the Fed announced a, quote, pilot climate scenario analysis exercise, end quote, with 6 of the largest U.S. banks. Now, we're told that this is merely an exercise in ensuring that banks understand their risks. But the data, including the Fed's own research, shows there's no physical risk to banks from severe weather events. The only other risk is so-called transition risk. We also know that banks are fully capable of pricing risks into their business decisions, including risks from changing customer preferences over time. So the real risk here is political. My worry is that an attempt to somehow quantify this political risk will eventually result in regulations designed to allocate capital away from carbon-intensive companies. It appears some bank regulators are already committed to doing just that. For example, the Fed, the FDIC, and the OCC have all joined the Network for the Greening of the Financial System. This is an international group of financial regulators with a stated aim to, and I quote, mobilize mainstream finance to support the transition toward a sustainable economy, end quote. In other words, their goal is to allocate capital away from carbon-emitting industries to those deemed to be sufficiently green. Now, let me emphasize, the Fed, the FDIC, and the OCC have all joined this group. The NCUA has also warned that credit unions, and I quote, may need to consider adjustments to their fields of membership as well as the types of loan products they offer, end quote, and that's because of global warming. So here's the reality. Some unelected financial regulators want to accelerate the transition to a low-carbon economy by misusing their powers to allocate capital away from traditional energy companies. But addressing global warming requires really difficult political decisions. It involves trade-offs. And in a democratic society, these kinds of trade-offs have to be made by elected and accountable representatives of the American people who are held accountable through the political process. I supported Vice Chairman Barr's nomination, despite a number of policy differences I have with him, based in part on his commitment to stick to the Fed's narrow mandate. At his confirmation hearing, Vice Chairman Barr stressed that the Fed, and I quote, should not be in the business of telling financial institutions to lend to a particular sector or not to lend to a particular sector, end quote. I thank him again for that clarity, and I urge him to keep to that commitment. And one way we could do that is by pulling the Fed out of the politically contentious issue of global warming. Federal banking regulators have also been preoccupied in some cases with establishing new rules, the need for which have been dubious. For example, last month, the Fed and the FDIC proposed potential new requirements concerning the resolvability of regional banks. Now, this proposal seems to be predicated on the assumption that the only realistic option to resolve a large regional bank would be to sell it to an even larger bank. But it's not at all clear that that assumption is warranted, or that new requirements are appropriate for regional banks for at least two reasons. First, the Fed and the FDIC have been approving regional bank resolution plans for nearly a decade. Nowhere do those plans contemplate wholesale acquisition by larger banks. Second, large regional banks have more than doubled their loss-absorbing capital since the financial crisis, and this dramatically improves their resiliency and dramatically decreases the likelihood that they would need to be resolved. Now, maybe some regulators seem to think that benefits of new regulations always outweigh the costs, but we know that regulation is not without cost. And as regulation increases, financial activities will continue to migrate out of the banking system as they have been doing in recent years. Now, while some of our banking regulators have been distracted, they've failed to address real challenges facing the financial system. For example, last year, the Fed, the FDIC, and the OCC committed to providing greater clarity on the involvement of banks in crypto activities, such as providing custody services or issuing stablecoins. Well, over a year later, they've still provided no public clarity. And during that same period, we've seen several high-profile collapses of crypto companies, including a very prominent example just last week. I think it's very possible that customers harmed by these collapses would have been better off if their crypto assets had been safeguarded by regulated banks that have been providing custody services for other kinds of assets for literally hundreds of years. But many banks have been pressured by you not to provide crypto-related services until your agencies provide this clarity, which just hasn't been forthcoming. I will note, however, that Chairman Harper seems not to have pursued this pressure campaign with credit unions. In fact, he's issued guidance for credit unions on partnering with crypto companies or using distributed ledger technologies. However, the ambivalence of the remaining agencies has helped to push crypto activities into foreign jurisdictions with weaker or no regulatory regimes. I mean, as a general matter, it seems to me the failure of Congress to pass legislation in this space and the failure of regulators to provide clear guidance has created ambiguity that has driven developers and entrepreneurs overseas, where regulations are often lax at best. One other item I want to highlight before we start the rest of the discussion, and it's the deteriorating liquidity in the U.S. Treasury market. In March of 2021, the Fed committed to modify the supplementary leverage ratio, or SLR, in part to facilitate bank dealers' ability to intermediate in this market. Over 18 months later, the Fed still has not acted. Now, I understand Vice Chairman Barr has only been in this role for 4 months, and he has reasonably suggested that potential amendments to the SLR should be in the context of reviewing all capital requirements. I understand that. But we really should recognize that a significant decline in Treasury market liquidity is already occurring, and absent an improvement, I'm afraid that the Fed might one day decide it has to intervene by restarting bond purchases, which would be quite contrary to its current mission of getting inflation under control. What I hope I'll hear from our banking regulators today is that they will prioritize these and other real challenges and not stray beyond their mandates into politically contentious issues or establish unnecessary new regulatory burdens. Thank you, Mr. Chairman.
Thank you, Senator Toomey. I'll introduce the four witnesses. Michael Barr took office as Vice Chair for Supervision of the Board of Governors of the Federal Reserve System, July of 22, for a 4-year term. He also serves as a member of the Board of Governors Todd Harper was sworn in to serve a full term as the National Credit Union Administration Board Chair in July of 2022. Martin Gruenberg has been the acting chair of the FDIC Board of Directors since February of 22. He's been previously confirmed to serve as chair and vice chairman of the FDIC and has served at the FDIC since 2005. Michael Sue became acting controller of the currency in May of 2021. Mr. Barr, if you begin your testimony, thank you.
Thank you very much, Chairman Brown, Ranking Member Toomey, and other members of the committee. Thank you for the opportunity to testify today on the Federal Reserve's supervisory and regulatory activities. As Vice Chair for Supervision, my priority is to make the banking system safer and fairer. The banking system is constantly evolving, so regulation and supervision must adjust to respond to new and emerging risks. Reforms following the global financial crisis have helped the United States maintain a resilient financial system for consumers, businesses, and communities. Capital and liquidity positions remain above regulatory requirements. But we must ensure we are keeping pace. Many issues at the forefront of banking regulation today were not prominent previously, and some of them scarcely even existed. Few anticipated a global pandemic, and recent events in crypto markets have highlighted the risks associated with new asset classes when not accompanied by strong guardrails. Turning to a number of our priorities at the Federal Reserve, I'm taking a holistic look at the Fed's capital framework to assess whether it is functioning as intended and supports a resilient financial system. I believe the capital framework should be forward-looking, should be tiered so that the highest standards apply to the riskiest firms, and should support a safer and fairer financial system. In recent years, merger activity and organic growth have increased the size of large banks, which could complicate efforts by regulators to resolve those firms upon failure without disruption to customers and counterparties. The board and the FDIC recently invited comment on an advance notice of proposed rulemaking to enhance regulators' ability to resolve large banks in an orderly way should they fail. The Federal Reserve is also evaluating our approach to reviewing banks' proposed acquisitions. Mergers are often a feature of vibrant sectors, but the advantages that firms seek to gain through mergers must also be weighed against the risks that mergers can pose to competition, consumers, and financial stability. Another priority is monitoring the risk of crypto asset-related activities. Crypto asset-related activity requires effective oversight that includes safeguards to ensure that crypto companies are subject to similar regulatory safeguards as other financial service providers. We are also working to understand financial risks related to climate change. At the Fed, our mandate in this area is important but narrow, and we are focused on our supervisory responsibilities and our role in promoting a safe and stable financial system. To that end, the Federal Reserve recently announced a pilot climate scenario analysis exercise designed to enhance the ability of supervisors and firms to measure and manage climate-related financial risks. As the banking system continues to evolve, we must ensure that supervision and regulation keep up with those changes and are appropriate for the underlying risks. As Vice Chair for Supervision, I'll continue to work to promote a safe and fair banking system. Thank you, and I look forward to your questions.
Thank you, Mr. Barr. Mr. Harper, thank you for joining us.
Chairman Brown, Ranking Member Toomey, and members of the committee, thank you for inviting me to discuss the state of the credit union system. While the economic fallout of the COVID-19 pandemic, along with rising interest rates, have influenced credit union performance over the last year, the credit union industry overall remains on a solid footing. At the end of the second quarter, there were just under 5,000 federally insured credit unions with nearly 133 million members and more than $2.1 trillion in assets. Notably, the industry's aggregate net worth ratio rose to 10.42%, representing a recovery of 40 basis points from a pandemic low. Further, the National Credit Union Share Insurance Fund continues to perform well, with no premiums or distributions expected at this time. During the last year, the NCUA has undertaken several notable actions to strengthen capital, enhance cybersecurity, and support small and minority credit unions. To fortify the credit union system's ability to better withstand future crises, the NCUA implemented its risk-based capital rule, along with a simplified compliance option at the start of 2022. The agency also has begun deployment of its new scalable information security examination program to allow the NCUA to better evaluate credit union cyber risks. Further, the agency has increased the resources available in the field to assist small and minority credit unions, and we will soon modify our examination procedures for minority credit unions to better recognize their unique strategies. Additionally, the NCUA is paying closer attention to consumer financial protection, which buttresses and complements our safety and soundness efforts. This year, NCUA examiners are reviewing compliance with pandemic assistance programs, fair lending rules, service member protections, fair credit reporting laws, and overdraft programs. We have also increased the resources for fair lending supervision. And as we move into 2023, the NCUA is emphasizing that all credit unions remain vigilant in managing safety and soundness and consumer financial protection to prepare for rising interest rates, inflationary pressures, liquidity concerns, and cybersecurity risks. Additionally, as the financial services system and credit unions continue to evolve, especially with many credit unions growing larger and more complex, the industry's regulatory framework must keep pace to maintain the strength and stability of the credit union system. In response to these changes and to legislation recently enacted into law, the NCUA has undertaken several rulemakings or implemented new rules during the last year. These rules address member expulsion procedures, subordinated debt, emergency capital investments, and cybersecurity notifications. Finally, I want to highlight two legislative changes that would help the agency better fulfill its statutory mission. Most timely, the NCUA requests a permanent adjustment to the agent member requirements for the Central Liquidity Facility. Notably, the extension of this enhancement comes at no cost to the taxpayer, as scored by the Congressional Budget Office. Currently, corporate credit unions may serve as an agent for a subset of their members, but without legislative action, by year's end, 3 out of every 4 credit unions, including most minority credit unions, will soon lose their access to an important federal liquidity backstop. And the credit union system's capacity to address liquidity events will shrink by $10 billion. With growing interest rate risk and rising liquidity concerns, now is not the time to decrease the access to the system's liquidity shock absorbers. The NCUA is also seeking restoration of its ability to oversee third-party vendors. This statutory change would provide the NCUA with parity with other agencies that supervise and regulate federally insured depository institutions. This examination authority is critical given the system's increased reliance on third-party vendors and credit union service organizations. The Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's Office of Inspector General have all recommended that Congress restore the NCUA's vendor authority. The U.S. House of Representatives has passed legislation as part of the 2023 National Defense Act to reinstate the NCUA's vendor authority. And in the Senate, bipartisan legislation has been introduced, for which I would like to thank Senators Ossoff, Lummis, and Warner. Their bill, the Improving Cybersecurity of Credit Unions Act, would close a growing regulatory blind spot. That concludes my statement. I look forward to your questions.
Thank you, Mr. Harper. Mr. Gruenberg, welcome.
Thank you, Chairman Brown, Ranking Member Toomey, and members of the committee. I very much appreciate the opportunity to appear today at this hearing on the oversight of the financial regulators. In my oral remarks today, I'd like to focus on the state of the U.S. banking industry and the outlook for the industry. To begin with, the U.S. banking industry today has reported generally positive results for this year amid continued economic uncertainty. Loan growth strengthened, net interest income grew, and most asset quality measures improved. Further, the industry remains well capitalized and highly liquid. The number of institutions on the FDIC's problem bank list remained stable in the second quarter of this year at 40 institutions. That's actually the lowest number since quarterly reporting of that data began in 1986. 14 new banks opened through October 2022, including the first mutual bank in 50 years. And additionally, no banks failed during 2021, nor this year as well. At the same time, the banking industry reported a moderate decline in net income in the first 2 quarters of this year from a year ago, primarily because of an increase in provision expense at the largest institutions, and that's worth paying some attention to. The increase in provision expense, that's the amount set aside by institutions to protect against future credit losses, reflects the banking industry's recognition of risks related to persistent economic uncertainties and slowing economic growth, as well as the increase in loan balances. Rising market rates and strong loan growth supported an increase in the banking industry's net interest margin from the first to the second quarter. As a result, most banks reported higher net interest income compared to a year ago. However, rising interest rates and longer asset maturities also resulted in unrealized losses on investment securities held by banks, and there's a significant overhang here. As of the second quarter of 2022, banks reported $470 billion in unrealized losses as the market value of securities fell below the book value. The FDIC expects this trend to be an ongoing challenge as interest rates continue to rise in the third quarter, especially if banks should need to sell investments to meet liquidity needs. In summary, despite favorable performance metrics, the banking industry continues to face significant downside risks that we need to pay attention to. These risks include the effects of inflation, rising market interest rates, slowing economic growth, and continued geopolitical uncertainty. Taken together, these risks could reduce profitability, weaken credit quality and capital, and limit loan growth in coming quarters. Further, as I mentioned, higher market rates have led to continued growth in unrealized losses in the banking industry's securities portfolios. Higher rates may also erode real estate and other asset values, as well as hamper borrowers' loan repayment ability. So these are all matters that we'll be paying at the FDIC close attention to over the course of this year and next. In my written testimony, I provide an overview of the condition of the FDIC's Deposit Insurance Fund and the reason behind the FDIC's decision to increase deposit insurance assessments by 2 basis points next year to avoid a potentially larger, more pro-cyclical increase later at a less favorable point in the economic cycle. I also update the committee in my written testimony on 5 key policy priorities for the FDIC: strengthening the Community Reinvestment Act, addressing the financial risks that are likely to affect banking organizations in the financial system as a result of climate change, reviewing the bank merger process, evaluating the risks of crypto assets to the banking system, and finalizing the Basel III capital rules. I also discussed the FDIC's efforts to support minority depository institutions and community development financial institutions, promote a diverse and inclusive workplace at the FDIC, strengthen cybersecurity and information security within the banking industry, and the FDIC's recent return to in-person banking examinations and other in-person activities at every level of the agency. I'd be glad to respond to questions from the committee on these or any other matters.
Thank you, Mr. Gruenberg. Mr. Sue, welcome.
Chairman Brown, Ranking Member Toomey, and members of the committee, I'm pleased to appear before you today to provide an update on the activities underway at the OCC. The mission of the OCC is to ensure that national banks and federal savings associations operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. Since my appointment, to fulfill this mission, we have focused on 4 priorities: guarding against complacency, reducing inequality in banking, adapting to digitalization, and managing climate-related financial risks. My written statement describes the progress the OCC has made on each of these. Here, I would like to focus on how we are helping to ensure that banks serve the needs of their communities. First, I want to highlight the OCC's commitment to community banking. We are taking specific actions to support community banks, including revitalizing minority depository institutions, reducing community bank assessments, promoting de novo startup banks, and tailoring regulation based on size and complexity. Second, the OCC continues to encourage the banks we supervise to improve their products and services, including overdraft programs, with their customers' financial health in mind. Many of these banks, including nearly all of the largest banks, have begun reforming their overdraft programs and lowering fees. While more work needs to be done, consumers are benefiting from the efforts of national banks to reduce penalty fees and the daily number of overdrafts charged, to provide grace periods before fees are imposed, and to end non-sufficient funds fees. By some estimates, changes at the largest national banks could save consumers billions of dollars annually. Additionally, the OCC has strengthened its supervision of compliance with fair lending laws. We recently updated our process for screening bank retail lending activities to provide more risk-focused fair lending examination strategy to identify weaknesses or wrongdoing. Where we find evidence of potential discrimination, we refer those matters to DOJ and HUD as applicable. Redlining and other forms of lending discrimination are unacceptable, especially in this day and age, and we will not hesitate to take enforcement action if necessary. The OCC, in coordination with the Federal Reserve and FDIC, as well as the DOJ, is also considering updates to the framework for analyzing mergers under the Bank Merger Act. This is to ensure that resulting entities continue to meet the convenience and needs of the community, support financial stability, enhance competition, and are safe and sound. The OCC considers each merger application on its merits against these statutory factors and associated regulatory criteria. We are planning a public symposium in February to explore this important issue further. As the digitalization of banking accelerates and bank fintech partnerships grow, the OCC is focused on ensuring that our expertise and regulatory framework adapts so that safety, soundness, and fairness of banking is maintained and even strengthened. We recently announced that we will be establishing an Office of Financial Technology early next year, building upon the work and successes of the agency's Office of Innovation, which was created in 2016. This change will enable us to engage more substantively with non-bank technology firms and to better supervise bank fintech partnerships so that we can help ensure that consumers of banking services are treated fairly, as well as help maintain a level playing field as the industry evolves. With regards to crypto, the OCC has adopted a careful and cautious approach. Last November, we issued guidance which reminds the banks we supervise that they are not permitted to engage in certain crypto activities unless they can perform these activities in a safe and sound manner. This approach helped to mitigate the risk of contagion from crypto to the federal banking system after the collapse of Terra Luna this spring, as well as more recently with the bankruptcy of FTX. Finally, let me say a few words on climate-related financial risks. The OCC's approach is firmly rooted in our mandate to ensure that national banks operate in a safe and sound manner. It is not our role to tell bankers who to bank or not to bank. We do not pick winners and losers. Rather, our focus is on risk management in making sure banks, especially large banks, have the necessary capabilities to identify, measure, and monitor their risks. We are committed to staying in our safety and soundness lane, not on setting industrial policy. This is important to our credibility as a safety and soundness supervisor. In closing, I remain committed to ensuring that OCC-supervised banks operate in a safe, sound, and fair manner, meet the credit needs of their communities, and comply with applicable laws and regulations. I look forward to answering your questions. Thank you.
Thank you, Mr. Zhu. Thanks to the four of you. This year, we've seen cryptocurrency values collapse by $2,000 billion, and markets crash, crypto exchanges implode, file for bankruptcy, investors losing their money, workers losing their jobs. The parallels to past financial crises through our history are troubling. From wildcat money in the mid-1800s to the dot-com bubble burst in the 1990s to the over-counter derivatives that led to the 2007-8 financial crisis. Unlike traditional bank or credit union deposits, which Americans use to get paid, buy necessities, build their savings, private cryptocurrencies are not backed or protected by the government, and they shouldn't be. We've seen them used for speculation and fraud and scams, sanctions evasion, outright theft. There doesn't seem to be anything useful or beneficial that hundreds of speculative cryptocurrencies can be used for. Since I've been chairman of this committee for close to 2 years, many on my side of the aisle have raised warning flags about this. The last thing we need is for risky new financial products to crash our financial system. Thank you those of you on this panel for your skepticism about cryptocurrencies, and we will continue that work. As all of you pointed out, digital assets pose risk to our financial system. There are many other risks we need to focus on to ensure banking and credit union system is resilient for consumers and small business owners. So a question for all four of you: what are the biggest risks that your agencies see? How could they harm working families and small businesses on Main Street? What are your agencies doing to protect against them? I'll begin with Mr. Harper, then Mr. Gruenberg, then Mr. Tsu, then Mr. Barr. So if you would answer, each of you take a moment or so and answer those questions.
Certainly. Generally, I see four risks that are coming down the line. First is interest rate risk for the institution itself. Second is liquidity risk. The third is cybersecurity risk, and something that we're watching on the horizon would be credit risk that happens, particularly as unemployment rises. There is a correlation in the numbers that shows that as unemployment rates go up, we often see an increase in charge-offs and defaults. That's something that we're going to be watching very closely moving forward.
Thank you. Mr. Gruenberg.
Thank you, Mr. Chairman. I think first and foremost, as I outlined in my oral statement, I do think we're at an inflection point here in the economy, with the Fed having shifted the conduct of monetary policy, and we have a rising interest rate environment. And I do think that presents a number of potential downside risks to the banking system that I outlined earlier. I think our institutions are going to have to pay close attention to the interest rate risk that's accumulated on their balance sheet, both through longer-term assets that they've accumulated, and I mentioned in particular the unrealized losses on securities on their balance sheets. And I also think there are asset exposures that our institutions have, particularly in commercial real estate, which we've had experience with during other times of potential economic and financial stress, as well as in the mortgage market. So I think from a supervisory standpoint, with the changing economic environment as financial regulators and banking regulators, we're going to have to pay close attention in particular to these developing issues.
Thank you, Mr. Tsu.
So I think the greatest risk is the risk of complacency. The risks that are facing the bank industry are fairly well known at this point: interest rate risk, credit risk, operational IT risk, cyber risk. The risk that banks are facing is that they are not paying sufficient attention and vigilance to that as we deal with other more headline risks such as crypto. There are some tail risks that are also out there that we need to pay attention to: global geopolitical in the commodity space, non-bank financials. These are also well known and have been identified by the FSOC and others. So just encourage banks and supervisors to stay on top of those. Thank you.
Thank you. Mr. Barr.
Thank you. Like the others, we're paying careful attention to the way in which supervised institutions are managing liquidity risk and interest rate risk. Cybersecurity is always an issue to be watchful for. We're worried about making sure that financial institutions are thinking about potential risks if the economy softens. So particularly, as others have said, in commercial real estate, residential housing, which are the sectors most often that are leading indicators for risk in that area. We're paying attention to longer-term risks as well. We talked, I think all of us, about the longer-term risks with respect to climate change. Events abroad might cause disruptions in the United States. So the war in Ukraine, Russia's war in Ukraine, obviously is devastating for the people of Ukraine and also creates enormous potential risks in Europe and elsewhere. And we're paying careful attention to risks in China as well, with slowing growth there and a political turn inward that may cause additional risks to happen. And lastly, we're concerned about the risks that we don't know about in the non-bank sector. That includes, obviously, crypto activity, but more broadly, risks in the parts of the financial system where we don't have good visibility, we don't have good transparency, we don't have good data. That can create risks that blow back to the financial system that we do regulate. And so we pay careful attention to understanding those risks as best we can.
Thank you, Senator Toomey.
Thank you, Mr. Chairman. I want to follow up on a comment the chairman made. I think I heard the chairman refer to crypto as risky new financial products, and the insinuation was that they might have the ability to crash our financial system. I think there's a really important distinction that I want to underscore here. If you look at what happened with FTX, what at least appears to have happened by a very extensive coverage, this is fundamentally not about the kind of assets that were held by FTX. It's about what individuals did with those assets. There are a lot of corollaries, there are a lot of analogies here. One comes to mind. In 2011, MF Global, commodity brokerage firm. It was run by former New Jersey Senator John Corzine. It collapsed after customer funds were misappropriated to fill a shortfall caused by the firm's exposure to some trading that went south. Now, nobody suggested that the problem was the instruments that were used. The problem was the use of customer funds. Similarly, the 2008 financial crisis involved disastrous consequences with what people were doing with mortgages. Did we decide we got to ban mortgages? Of course not. So let's look at FTX. It certainly appears to be an egregious failure to treat customer assets as segregated assets. It appears that the leadership there attempted to fill a hole at an affiliated company. And it occurs to me that this is a worry that I don't have for one split second about my stocks or my bonds or my treasuries when they're held in custody by American banks. Mr. Su, a predecessor of yours, said that there's no need for any additional guidance. It's a settled matter as to how banks should custody financial assets. And they do it all the time, and they've done it forever. But my understanding is that your office discourages banks from providing custody services, among other services, in the crypto space. And it seems to me if people had access to custody services provided by a wide range of institutions, including regulated financial institutions, they might be able to sleep more comfortably knowing that those assets were unlikely to be used for some completely inappropriate purpose. So is it true that you discourage banks from engaging in crypto custody services?
We discourage banks from doing things that are not safe, sound, and fair. And so the custody that you described of traditional assets, it is true. Banks have been doing that for a long time.
Right.
They know how to do that. We know how to do that. The custody of crypto is different. There are some underlying fundamental issues and questions regarding what does it mean to own custody through a custody, to own crypto through a custody, which have not been fully worked out. So it's not mature.
So this activity, crypto trading, people holding crypto assets, has been going on for many years. Why haven't you provided the clarity? Why haven't you provided guidance so that it is clear and we could have customers have the assurance of having their assets stored by reliable institutions?
If banks can demonstrate that they can do that activity in a safe, sound, and fair manner, we're all ears.
But I think some of this obligation is on you to provide some clarity about how that could work. And as I say, what I'm hearing from the industry is that this activity is being discouraged, and the result is not that the activity doesn't occur, it's just that it goes somewhere where the regulation is often lax. Let me move on to another aspect of this. Vice Chairman Barr, you recently said that there are types of crypto-related activities where the Fed may need to provide guidance to the banking sector. In your view, is custody a category of crypto activity that the banking sector can provide and could use some guidance?
Thank you, Senator Toomey. I do think that it would be useful for us to provide guidance to the banking sector about how to safely custody crypto assets. It's something I look forward to working with my colleagues on. I think we've seen in the context of recent events that if you have a set of firms that are trying to operate outside the regulatory perimeter, trying to avoid compliance issues, that can create enormous problems for consumers, for investors. There's huge problems that these investors experience that I don't think anyone wants to see happen.
Let me just a quick follow up here. My understanding is the SEC has put out guidance recently that would require issuing firms that custody crypto to put that crypto on their own balance sheet. Now, that is contrary to the way custody services are treated in every other category of asset that I can think of and always has been. If that were the case, if you're a firm that doesn't care about having a bloated balance sheet, maybe you don't care, but banks have a reason to be very concerned about increases in their balance sheet because it has capital requirements. Wouldn't this impose a significant cost on banks if they are, in fact, obligated to put all of the custody assets, crypto custody assets, on their balance sheets?
Well, we've seen banks operate in a pretty cautious way to date. There are very few institutions that are currently seeking to engage in custody activity. Of course, we require all of our regulated financial institutions to comply with accounting rules, including accounting interpretations issued by the SEC. And so publicly traded banks would need to comply with that rule. And it would have the result that custody of crypto assets, you would need to hold capital against.
In a way that is not required of any other category of financial assets.
In a way that is not required for traditional custody of non-crypto assets. And so that differential would impact bank decision-making.
Yeah. Thank you very much.
Thank you, Senator Toomey. On behalf of the chairman, I will recognize myself. Gentlemen, thank you for being here today. Vice Chairman Barr, the Volcker Rule prohibits Wall Street banks from making investments in hedge funds and private equity funds. The legislation was passed in 2010 with the hope that those investments could be liquidated quickly, but there are some that were deemed to be too illiquid or too difficult to be dispensed with immediately. And so there was an extension to July 2022, 12 years. And yet there are still institutions that still have not disassociated themselves and disinvested. You've given them extra time. Is this going to be an endless process, or why can't they get it done?
Senator Reed, thank you. I agree with you. I think the time has come for those divestments to happen. The Volcker Rule provided, as you said, until July of this past year to get that done. Some firms, I believe, were erroneously relying on a legal interpretation that would not require them to do those divestitures. I think that's an incorrect legal interpretation. We'll be clear with them that it's time to get those divestitures done. Some of them may need a small amount of time to get that done, but we're not going to see continued extensions beyond that.
Thank you very much, John. Mr. Gruenberg, the Fed raises interest rates. Historically, banks usually follow with their savings rates. In fact, according to industry research, the deposit rate should start ticking up when the Fed's target rate hits about 1.33%. Well, the Fed's target rate is now 4%, and the national average interest rate on a savings account is now 0.2%. But the nation's biggest banks are even lagging that average. They're at 0.1%. So why do you think the biggest banks have been lagging so much in terms of sharing their beneficence with their savers?
Well, thank you, Senator. It's pretty clear that the banking industry is trying to take advantage of rising interest rates on the credit product side to increase earnings. And fair to say that what they're paying out on the deposit side has lagged that. We'll see if competitive pressures within the industry, impact what they may offer on deposit accounts. But right now, there's clearly a lag.
Thank you. Let me follow up on another question, Mr. Gruenberg. There has been a situation where banks are partnering with fintech companies. It's been described as rent-a-bank, where the fintech company comes in and uses the bank as an intermediate to avoid use-free limits and other restrictions. And many of these are your institutions. What are you doing to try to stop that?
Thank you for the question, Senator. When a bank partners with a third party, and the third party is providing services on behalf of the bank, including credit products, as a supervisory matter, the offering of services by the third party are treated as if the bank itself is offering those services and products, and the bank is supervised accordingly. We have a number of institutions that are utilizing partnerships to benefit from the banking relationship. There are several institutions. I will say we are taking a close look, particularly at the lending activity going on, to ensure that the lending activity is being appropriately underwritten and that it's based on the borrower's ability to pay, as well as consumer protection requirements in terms of disclosure and transparency are being complied with. And this is a matter of active attention for us, and I appreciate you asking the question.
Well, thank you very much. Now, on behalf of Chairman Brown, let me recognize Senator Rounds.
Thank you, Mr. Chair. Vice Chair Barr, welcome back to the committee and congratulations on your confirmation. In recent speeches, you've announced that you would be conducting a holistic review of the capital framework for our financial institutions. Included in that evaluation will be a review of the supplementary leverage ratio, or SLR, the countercyclical capital buffer, and stress testing. This review is long overdue, as the Fed has said for months that it would reassess both the GSIB surcharge and the SLR. In the process, it is important that we strike a balance between financial stability and economic growth. In order to achieve that balance, I believe the Federal Reserve must be transparent and consider input not only from Congress, but from stakeholders on any adjustments. When do you expect this review to be complete, and will you commit to providing a transparent, formal, public process with a comment period for any resulting adjustments to SLR, the GSIB surcharge, stress tests, or countercyclical capital buffer?
Thank you, Senator Rounds. We're conducting that review now. We're in the middle of that. I expect that early next year we'll be able to say more about where we are in that process. If any of these parts of the review require us to rethink a rule like the ESLR, the countercyclical capital buffer, and the like, we would, of course, seek public comment as part of that process. We will issue a proposal, get comments in, evaluate those comments, understand them, and then lead to any action we took on a final rule. So we would follow a normal process on that.
Thank you. Chair Harper, late last year, the NCUA approved its 2022-2026 draft strategic plan, which included an analysis of the internal and external environment impacting NCUA and evaluated the agency's programs and risks. It included language suggesting that as a result of changing weather disproportionately affecting farming communities, credit unions should consider adjustments to their membership. This was very problematic language, as it implied that credit unions that primarily serve agricultural communities may have to alter their memberships or face increased costs and regulations. As a result of the actions of Senator Kramer and myself, that language, thankfully, was not included in the final draft. Chair Harper, will you commit to avoiding similar problematic language in future strategic plans and commit to not punishing credit unions for supporting their local farmers, ranchers, and agribusinesses in their communities?
Yes.
Thank you. It has been widely reported that the CFPB is planning to shift liability for peer-to-peer payments that consumers make to a scammer. Scammers would likely profit from such a policy because, armed with an official government document, they will be able to induce people to pay them by telling them there is no risk in sending the money, even if the circumstances are suspicious. However, banks, unlike the consumer, would have no insight into the transaction to be able to stop it. My question for Vice Chair Barr, are you concerned there will be an impact on bank safety and soundness given banks' inability to identify or stop the fraud and the size of potential fraud losses banks could incur? And furthermore, has there been any research done to determine how fees would increase and what new costs consumers would bear if this is implemented?
Thank you, Senator Rounds. The regulations at issue, Regulation E, are implemented by the Consumer Financial Protection Bureau. So in the first instance, I think it makes sense for them to figure out what they would like to propose, if anything, in that area, and then we'd be able to understand the implications of that proposal more broadly. But I don't have any further insight about it at this time.
No existing studies at this point.
I don't know the answer to that. None that I'm aware of, but there may be others that exist that I don't know of.
Thank you. Following an influx of deposits generated by government stimulus, the FDIC approved an aggressive proposal to uniformly increase bank deposit insurance assessment rates by 2 basis points until the deposit insurance fund reaches a designated reserve ratio of 2%. This proposal has the potential to disproportionately harm community banks by forcing them to pay between 5% and 25% of their pre-tax income for insurance assessments. Meanwhile, the OCC recently approved a 40% reduction in assessments for OCC-chartered community banks. Acting Chair Gruenberg, could you please explain your logic behind supporting increases to community banks' FDIC deposit insurance assessment rates well beyond the statutory requirement? And was a study done to determine the ratio of 2%, or is that an arbitrary number?
The 2% was the subject of careful analysis and was reached based on the FDIC's experience during 2 crises. And just to be clear, if I could take a moment to explain, because it's a little complicated, under the statutory requirement, there's a minimum reserve ratio for our deposit insurance fund of 1.35%. And if that ratio falls below, the FDIC is required by law to establish a restoration plan to bring it back up to the 1.35% minimum. As you noted, at the beginning of the pandemic, there was an inflow of insured deposits, and it pushed the ratio down. And the FDIC, back in 2020, adopted a restoration plan that did not envision increasing assessment rates. And we expected, that was based on an expectation, frankly, that as, frankly, the pandemic progressed, the growth in insured deposits would slow down. And what occurred is that over the past year, from the second quarter of this year to the previous, the insured deposit growth rate remained very high at 4.3%. So we had projections that envisioned us being able to restore the reserve ratio fund to the statutory minimum by the statutory deadline of 2028. We thought we could do that without an assessment adjustment. Because the growth rate stayed high, it shifted our projections and really put in question whether we could get to the minimum in time. So we had a tricky call to make, and I'll just be candid. We could have delayed and hoped that the growth in insured deposits would slow down and the problem would take care of itself. The problem there, and I'll come quickly to a conclusion, was that if we were wrong, we then might have to impose a larger assessment on the industry at a later stage of the cycle when the industry would be in not in as good a position to absorb it. So we opted for a 2 basis point increase. That's about 1.2% of industry income. We did not envision that impacting lending or credit availability, but it would assure us of putting the fund in a solid position, particularly since we're heading into a uncertain period. So it was a tricky call, but that was the judgment we made.
Thank you, Mr. Chairman, for your
Thank you very much. Let me, on behalf of Chairman Brown, recognize Senator Menendez.
Thank you. The collapse of FTX last week is the latest in a series of high-profile crypto collapses this year, which have left investors locked out and facing uncertain prospects for recovering their money. This should be a renewed call for Congress to take a serious look at crypto exchanges and lending platforms, many which engage in risky behaviors while marketing themselves as safe for consumers. Mr. Gruenberg, am I correct in saying there are no cryptocurrency firms backed by the FDIC?
That's correct.
In fact, at this time, FDIC insurance does not cover cryptocurrency of any kind. Is that correct?
That's correct, Senator.
Now, many of these firms are marketing themselves to consumers as safe and responsible while engaging in risky behaviors without the guardrails and safety nets that exist within the traditional financial system. In August, the FDIC issued letters demanding several crypto firms, including FTX, cease and desist from misleading consumers into believing their deposits were insured. The FDIC and Federal Reserve issued a similar letter in July to Voyager LLC, which collapsed earlier that month. What can we do to combat misinformation like this and better protect and inform consumers in the crypto space? Mr. Gruenberg?
Thank you, Senator. Listen, this has been a key priority for us. The strength of the FDIC is the public's confidence in our deposit insurance system. So if that confidence is put in question, it really puts the system at risk. And if we have financial players who are engaging in blatant misrepresentation in regard to deposit insurance coverage, that's not only a violation of the law by firms that do that, it really is a threat to the credibility of the FDIC and our deposit insurance system. So when we identified some companies in the crypto space and others, but engaging in misrepresentation, we acted very forcefully in sending letters demanding that they cease and desist and indicating that if they did not comply, we have enforcement authorities available to us under the law that we can bring to bear. We thought it was important in regard to those individual actors, and we thought it was important to send a message to those who would think about engaging in misrepresentation of deposit insurance.
I'm glad you did, and I think these exchanges having these troubles should instigate us and regulators to look at what regulations are needed to ensure investors in the overall financial system are protected. I want to thank all of you for jointly proposing a rule to modernize the CRA to increase lending in minority communities. We saw 2 years ago an assault on the CRA when the OCC acted alone and proposed a rule that would have left minority communities with less credit. And I thank Comptroller Sue for withdrawing that rule. According to the Census Bureau, there are over 26 million limited English proficient consumers in the United States, with 17 million of those consumers speaking predominantly Spanish. So, Mr. Barr, Mr. Sue, Mr. Gruenberg, do you all agree that language can be a barrier to assessing financial services?
Yes.
Yes.
Would you all agree that, for example, home mortgage loans and small business lending could increase in Hispanic communities if banks provided more documents and in-person services in Spanish?
Yes.
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 So I hope you'll all consider seriously in your services test an evaluation of a bank's ability to serve those with limited English proficiency. In August, I joined Chairman Brown and 17 of our colleagues in a comment letter urging you to include this in your final rule, incentivizing banks to offer more services, and for example, Spanish, will increase banks' ability to diversify their staff, something the banks still often fail to do. With a $1.8 trillion domestic marketplace, this would make a lot of sense for the banks as well as for the community. And they take their deposits, they should be also willing to work with them. Finally, Vice Chair Barr, as you know, the Federal Reserve has again the opportunity to appoint a Hispanic to a Federal Reserve Bank president at either the Kansas City or Chicago Federal Reserve Bank. In its 108-year history, the Federal Reserve has never had a Hispanic Federal Reserve Bank president. During your confirmation process, you made a commitment to develop a transparent process with meaningful public input on the selection of Federal Reserve leadership. I suggested 6 ideas to strengthen the Reserve Bank director and president selection process. You agreed at that time with all of them. Can you tell me what specific actions have you taken to implement any of those reforms?
Thank you, Senator. First of all, let me just start by saying there's a lot more work that has to happen. I think it's good that you've pointed out this issue and continue to point it out to the Federal Reserve. There have been a number of positive steps that I've talked through with my colleagues at the board. There's been progress in recent searches on the public posting, dissemination of position descriptions, and webinars and town halls to get public input. The public is, in these recent searches, undertaken solicitation of nominations, ideas from the public for individuals. There's been, in recent searches, engagement with public service organizations, with civil rights groups, with community organizations. There has not yet been progress on one of the items that you suggested, that's a public release of demographic information. And we're also considering the suggestion that you made, but haven't taken action yet with respect to getting public input on the process itself at the board or bank level. So we've made some progress, but we're still seeing a lot more work to do.
Well, let me just close by saying anonymized data is something that shouldn't be so hard, but would give us a window into the process. And the proof, ultimately, will be in whether or not there is a selection of a qualified individual, for which I believe there are many candidates. Thank you, Mr. Chairman.
Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chair. I have to start today by expressing my concern with President Biden's nomination of Mr. Gruenberg to serve as the FDIC chair. Mr. Gruenberg appears before us today on an anniversary, 10 years to the day of his confirmation to a 5-year term. Despite the fact that his term is long expired, Mr. Gruenberg has remained at the FDIC, most recently acting as chairman, despite not being confirmed by the Senate for a decade. During Mr. Gruenberg's tenure as FDIC chairman, the agency has had a severely blemished record, most notoriously Operation Choke Point, which sought to debank legal but politically disfavored businesses. Additionally, there were reports of mistreatment of employees and some allegations of racial discrimination in hiring. And just last year, while continuing to serve on the FDIC board, despite his long expired term, Mr. Gruenberg helped facilitate a partisan power grab of the FDIC board. His fellow Democrat board members, along with his fellow Democratic board members, blatantly discarded the FDIC's 90-year precedent of allowing the FDIC chairman to set the agenda, the agency's agenda, and in the process forced out Chair McWilliams. Until last year's coup, all previous FDIC board members, Democrat and Republican alike, had followed the agenda-setting precedent. That's something Acting Chairman Gruenberg knows quite well. At the beginning of the Trump administration, he served as FDIC chairman. Although Republicans outnumbered him on the board, they followed precedent and allowed him to set the agency's agenda. However, when the shoe was on the other foot, Mr. Gruenberg facilitated the erosion of FDIC independence, not unlike attempts here to nuke our Senate filibuster. We need nominees at the FDIC and other agencies who will uphold the long history of bipartisanship and political independence at federal financial regulators. Unfortunately, I've drawn the conclusion that Mr. Gruenberg does not fit that bill. Now, Mr. Barr, by the Fed's own measures and recent financial stability report, the bank sector continues to be well capitalized. The Fed reports that the results of the 2022 stress test indicate, I quote, large banks would maintain capital ratios well above the minimum risk-based requirements even during a substantial economic downturn. But now it's widely expected that the upcoming Basel capital proposal will significantly increase capital requirements. I'm not one of these members who say, give me a simple yes-no answer, but something close to that to these next 3 questions would really be appreciated. Do you believe capital levels are not strong enough?
Thank you, Senator. I'm engaged in a holistic review of all the capital requirements to see not only whether they're strong, but whether they're strong enough and how they work well together. Are they fitting together in a way that serves the interests of making the financial system safe? So I don't have a conclusion yet to that holistic review. I'm undertaking it now, and I'll have more to say about it in the first quarter of next year.
The analysis of the stress testing, though, seems to think that you're reasonably confident that current capital ratios are okay. So what's going to ultimately tip the scales to a different conclusion and maybe embrace the Basel report?
Thank you. We're looking really at all the factors. So the stress test is one important input into that. It of course determines the level of capital. So it's setting capital requirements in the course of deciding that the capital requirements are sufficient. The reason that it does that is because of the presence of the stress capital buffer. And so the stress test is one input into that. We're modeling, of course, not a prediction about the future, but one scenario that might that banks might need to address. And so that's an important factor, but not the only factor. We need to look at risks across the system. As I indicated in my testimony, for example, before the global pandemic hit in March of 2020, that wasn't on anybody's list of potential risks to the
Just
financial
a quick question. So if economic activity continues to slow and we increase capital requirements, is there a scenario where that's a good thing?
Well,
what would be a scenario where it's a good thing?
I'm not reviewing capital requirements to think about what the right capital level should be tomorrow. I'm trying to think about how we should set capital requirements over time through economic cycles. For any capital rule, there's a process. We'll do a proposal. We'll issue a final rule. Then there's an implementation period. So we're not trying to think about what capital should be tomorrow. We're trying to think over long periods of time, what are the right capital levels in the system.
Okay. Well, thank you all for being here, and we'll submit other questions for the record. My time's expired. Thank you, Mr. Chair.
Senator Tester of Montana is recognized.
Yeah, thank you, Mr. Chairman. I want to thank you all for being here in front of the committee today. I appreciate your leadership and your guidance. I wasn't going to talk about crypto, but I particularly appreciate your common sense approach on safe and sound and fairness, especially you, Mr. Sue. All of you are good on this. Look, I remember the meltdown in 07, the chairman talked about it, where we had synthetic financial instruments that may be attached to mortgages, but there was no there. And it ended up where we cut a pretty damn big check of taxpayer dollars to solve that problem. And I'm going to tell you, if you guys would have given guidance and you had given credibility, we'd be cutting another check. And so I just want to say thank you. I don't say that as a lawyer or an accountant. I say it as a farmer. Thank you. Thank you for what you've done. During a hearing last year, I had talked to Mr. Sue and Chairwoman McWilliams about the Community Reinvestment Act and the changes that were going to happen, and making sure that rural America and our native populations would be better, the investments would be made better in those countries. So the comment period has ended. It has not taken effect yet, but for Mr. Gruenberg and Sue and Barr, could you tell us how the new rules are going to ensure investment in native and rural America? Go ahead, Mr. Gruenberg.
Thank you, Senator. I will say that was a real focus of attention for the three agencies in developing the rule, how we could utilize CRA to provide incentives for increased bank lending and investment in rural communities and Native American communities, which are historically underserved and lack access to basic banking services. We did that through proposed changes in the two key tests under CRA, both the lending test and the community development test. By providing greater flexibility, we're not limiting the lending test just to the traditional branch-based assessment areas, but we have a statewide dimension to the test, which will give banks additional credit for serving rural communities as well as Native Americans. And we provide significant greater flexibility in the community development test so that banks can invest in underserved rural communities and Native American communities and get CRA credit for it, even though it's not part of their branch network. So these were key flexibilities that we think will be helpful.
Do you fellows have anything else you'd like to add to that? Go ahead.
I would just say, in addition to the CRA at the OCC, Native American issues are a top priority. And we have a Project REACH, which is to increase financial inclusion. We've had a special subcommittee focused on home ownership promotion for Native Americans because some of the legal issues there are tough for banks. So we've held a webinar trying to move that ball forward there. And I met recently with Treasurer Malerba, who's the head of the new Office of Indian Affairs, to see how the OCC and her office can work together to promote these issues.
Do you see any positive impacts on housing with the changes in the CRA in rural America? Go ahead, Mr. Barr, if you want to talk.
I think, obviously, the rule is not yet into effect, but I
Right.
think that we would see improvements on housing in rural America and in community development in rural America. And also just, emphasize the point that both Marty and Mike made, that the issues affecting Native American communities' access to financial services are longstanding. They've been problems for generations. And if we don't take seriously the need to fix those problems, including with the reforms to the Community Investment Act, Native American communities are going to continue to be left behind. So I think it's really a critical issue to be working on.
So before the pandemic started, I talked with your predecessors about what I've been hearing from bankers in Montana about the egg industry. Previous administration had some pretty silly trade wars, and it affected egg commodity prices in a big way. We have seen egg prices increase dramatically, but we've also seen input costs increase dramatically. So based on your examiners, what are you seeing from the community banks that are serving the agriculture community? How are they doing? Gruenberg, Sue, or Barr?
I will say, Senator, as a general matter, community banks in the United States have been doing quite well over the last several years, and that's certainly true as well for community banks in the agricultural sector.
Okay. Have the rest of you seen it the same way? Mr. Sue?
I'm hearing that they are doing quite well. I think there's some concerns about some headwinds, which is part of the reason why we lowered bank assessments for OCC banks, and we continue to engage with them. And I think that some of the drought issues for some of the banks in some parts of the country, luckily there's been crop insurance, but these are top-of-mind issues for the bankers and for supervisors.
Yeah, last question. I want this very quick. Mr. Sue, you talked about geopolitical uncertainty as it applied to the commodity space. What commodity are you talking about, or commodities are you talking about? Energy?
I think there have been some broad-based impacts across a number of different commodities markets. Depends on which time. At one point it was nickel, and that's shifted over to some other commodities. So it's a broad range.
Okay, thank you. Thank you, Mr. Chairman.
Senator Lummis of Wyoming is recognized.
Thank you, Mr. Chairman, and thank you all for attending today. Mr. Barr, I'm going to have a question for you in a minute about Regulation W, but I too want to weigh in a little bit on the FTX situation. It's awful and simultaneously not all that surprising. Until June 2021, FTX was offering ordinary retail customers outside of the U.S. leverage of about 101 to 1. That leverage is illegal in the United States because it's extremely likely that a customer loses all their money. So, no big surprise there. FTX lent out customer assets for proprietary trading with its affiliate Alameda Research, misusing its custody assets, which it did not own, and breaking its promises to its customers. So, like Senator Toomey, I agree, this is a lot like MF Global in 2011, and it should be absolutely forbidden. My state of Wyoming saw this problem coming in 2019 and banned banks engaged in digital asset activities from relending customer digital assets. Now, that may be surprising to some of the witnesses today, but Wyoming has a tough set of rules for digital assets, and I hope you'll look at those at at the Fed. There were deep interconnections between FTX and Alameda that encouraged both to take big bets with customer assets that ultimately brought both down. Banks today are subject to limits on affiliate transactions under Regulation W and are required to disclose their affiliate relationships. These limits exist to prevent special transactions like those that occurred between Alameda and FTX. So Senator Gillibrand and I incorporated many of those ideas into the Responsible Financial Innovation Act. And our act would have prevented the FTX bankruptcy by prohibiting misuse and lending of customer assets, requiring proof of reserves for digital asset exchanges, limiting affiliate transactions and providing clarity for affiliate relationships, and clarifying the bankruptcy treatment of digital assets so customers get their assets back quickly if an exchange fails. It's obvious that Congress needs to regulate digital assets, and the Lummis-Gillibrand bill is the legislation that most comprehensively addresses these issues in a way that balances consumer protection and responsible innovation. I'm confident that we can get good legislation passed in 2023, and I look forward to working with my colleagues to do that. Now, Vice Chair Barr, I want to turn to you again, talk about Regulation W. Why is it important that there be transparency on affiliate relationships for banking regulation, and why should Congress consider that for digital asset exchanges?
Thank you, Senator. Regulation W is one of the foundation regulations for banking. It's really a quite important rule, and it requires not only transparency but also substantive limits on the relationship between the bank and its affiliates. The basic idea is that we need to protect the insured depository from possibility of risks being transmitted from the affiliate to the insured depository, and therefore hurting the customers and the depositors of the bank, and potentially putting the deposit insurance system or taxpayers at risk. And so those kinds of limits on the kinds of transactions that banks can have with their affiliate are really a foundational part of banking law.
So applying that to, for example, the FTX situation, where there were over 130 related entities, would a Regulation W type of regulation have assisted in preventing or at least disclosing some of the concerns that developed with FTX?
Well, Senator, I only have available to me the information you hear reported about in the press, so I'm not sure I'm in a good position to opine on a particular case, a particular firm. I don't think that would be prudent. But I can say in general, Regulation W is a really foundational principle, and it's served the banking industry very well.
Thank you, Mr. Barr. Thank you, Mr.
Senator
Chair.
Warren of Massachusetts. I apologize to Senator Kennedy. You're next after her. I apologize. Thank you, Senator Kennedy. Senator Warren.
Thank you, Mr. Chairman. So since it was created by Congress just over 10 years ago, the Consumer Financial Protection Bureau, the CFPB, has forced financial institutions to return more than $13 billion directly to people they cheated. This is government that works for the people, literally. Now, the banks don't like losing $13 billion. They don't like being forced to shut down scams. So they and their Republican friends attack the CFPB. And the latest attack has come out of the Republicans' go-to court, the Fifth Circuit Court of Appeals. This court has ruled that the CFPB's funding structure is unconstitutional because it does not receive annual appropriations from Congress. So I just want to test that out a little bit. All of you are here today from major regulators that oversee various pieces of the financial system. the OCC, the FDIC, the Federal Reserve, and the National Credit Union Administration. So let me start with you. Acting Comptroller Sue, is the OCC funded from the annual appropriations process?
No.
Chairman Harper, does NCUA receive most of its funds from the annual appropriations process?
No.
Acting Chairman Gruenberg, is the FDIC funded from the annual appropriations process? And Vice Chair Barr, is the Fed funded from the annual appropriations process?
No.
So, in fact, I want to focus just a little bit more on the Fed. Vice Chair Barr, the Fed primarily gets its funding from earnings and assessments from the Federal Reserve banks. Is that exactly the same source where the CFPB gets its funding?
Yes.
So look, there is a good reason why Congress created independent funding structures for bank regulators. Your agencies are the cops on the beat that ensure the safety and the stability of the banking system. Your rules provide the guidebooks for financial institutions to serve consumers while acting within the law. Congress understood this even back in 1863 with the very first banking regulator, that if the ability of our regulators to do their jobs fluctuated every time Congress negotiated a spending bill or every time Congress changed hands, that the financial markets would be thrown into chaos. Vice Chair Barr, your job is to make policy, not to worry about the Fed's budget. But let me ask, does the Fed's independent funding structure help provide certainty and stability to banks and financial markets, because no one in the system has to worry about the Fed's ability to do its job or to have the resources to enforce the rules?
Yes, I believe that kind of certainty is quite important to doing our job effectively.
Well, unfortunately, the Fifth Circuit's argument implies that because all of you are and always have been funded outside the annual appropriations process, that all of your agencies are unconstitutional. This would mean that none of you can do the things that you are doing, from setting interest rates at the Fed to making sure that when people make deposits in their banks that they are protected by FDIC insurance. And it is not just your agencies. Numerous other government entities are also funded outside the appropriations process, including the Federal Housing Finance Agency, the Farm Credit Administration, and the Financial Stability Oversight Council. By the Fifth Circuit's logic, they would also be unconstitutional. Not only does that make no sense, it is also not what the Constitution says. The Constitution says, and I'll quote it here, "No money shall be drawn from the Treasury, but in consequence of appropriations made by law." And no money is withdrawn from the Treasury to fund any of our financial regulators. As Professor Noah Feldman notes, the Supreme Court has repeatedly and reasonably said that this clause, quote, means simply that no money can be paid out of the Treasury unless it has been appropriated by an act of Congress. For this reason, the U.S. Court of Appeals for the D.C. Circuit and a slew of district courts have all upheld the CFPB's funding structure. Even though this decision out of the Fifth Circuit is not grounded in law, it could have real consequences for the stability of our financial system. The Mortgage Bankers Association understands this risk. In 2019, they warned that if the CFPB were struck down, quote, the results could be catastrophic for the real estate finance industry. The Trump court ruling is not only shockingly dumb, it is also dangerous. That's what happens when courts play politics instead of following the law. Thank you, Mr. Chairman.
Thanks, Senator Kennedy is recognized from Louisiana.
Thank you, Mr. Chairman. Welcome, gentlemen. I think Senator Warren pointed out that you are major financial regulators, and we thank you for your time today. So let me ask you your opinion. Would any single one of you hire Sam Brickman-Fried to manage a food truck? Would any of you? Would any single one of you hire his girlfriend, Caroline Ellison, who apparently was trading billions of dollars, to manage a food truck? Can you tell me who in our federal financial services regulatory administrative state was watching FTX to make sure that no one there stole people's money? Was anyone watching them that you know of?
Senator, just from you're dealing with banking.
You're a brave man.
I understand. You're dealing here with banking and credit union regulators, and FTX was not engaged in the banking business or in credit union business.
I know. I'm not saying you should be. I'm just asking. Yeah. You guys are at the top of the food chain in terms of financial services regulation. Do you know who was watching? Who was watching these chuckleheads?
Well, these folks, I think, were engaging generally in investment and trading activity. And so in the first instance, if you're thinking about
looks to me like some of them were engaged in stealing.
Well, that's under investigation now, Senator. So I think in the first instance here, you'd probably want to engage with the market regulators, the SEC and the CFTC, to talk about the activities and the authorities in this area, candidly.
All right, I don't have a lot of time. I want to ask the chairman a few questions about inflation. Mr. Chairman, Professor Jason Furman, I think you know him at Harvard, formerly of President Obama's administration, has said that he thinks unemployment has to rise by 5 percentage points for a whole year to bring inflation down a single percent. Do you agree with that?
Thank you, Senator. Let me just start by saying inflation right now is far too high.
Yes, sir, but I'm going to run out of time. Doggone it. That's just our chairman. He's fair, but he's tough as a boot, and he's going to cut me off. Do you agree with Professor Furman?
I think that it's the case that we're going to see significant softening in the economy. I don't have a projection that precise as Jason Furman to comment.
Let me ask you about Professor Larry Summers. He says that unemployment is going to have to rise to 7.5% and stay there for 2 years to get inflation down to 2%. Do you agree with that?
As I said, I think that we're going to see softening in the economy, but I don't have a prediction as precise as that one.
All right. Can we agree? You remember the inflation back in the 1980s under President Reagan and President Carter, and when Mr. Volcker was chairman. Can we agree that the only way we got control of inflation then was on both the fiscal and the monetary side?
Well, at the end of the day, it's the responsibility of the Fed to assure price stability consistent with maximum employment. So we're focused on our responsibility.
I know that, but you can't, if you depend on monetary policy alone, interest rates have to go higher. Or let me put it another way. If Congress cooperated and stopped spending money like it was ditch water, Congress or the Fed wouldn't have to raise rates as high. Is that Is that a fair statement? To get control of inflation, of course.
I really won't have any comment on fiscal policy. We take the
You think fiscal policy is irrelevant?
we take the fiscal policy that elected members of Congress and the president enact, and we calculate those in our decision making. But I don't have a comment on fiscal policy.
You don't have any comment on the contribution that fiscal policy makes to inflation?
I really don't have anything to add about that.
Well, add to what? You haven't told me anything.
Add to what I said before.
You're not telling me that fiscal policy has nothing to do with inflation, are you?
I'm telling you that at the Fed, we take our monetary policy responsibilities as ours, and we leave to the elected
Well,
branches
don't you think you have
fiscal
a
policy.
moral obligation, if not a legal obligation, if you think fiscal policy is contributing to the inflation, to say something, for God's sakes?
I think it's important for us to respect the role of the Congress and the president in setting fiscal policy, and then to take that as a given in how.
Can
we
you
do
tell
our
me,
work.
given the path we're on, how high unemployment is going to go in order to get inflation down?
I think we're going to see unemployment go up, but I don't have a precise answer to your question.
Duh. I think you're right. I don't mean to make light of you. Can you give me any prediction how high? I mean, Summers and Furman are saying it's going to have to go through the roof.
I have seen a wide range of predictions about that, and as I
What
said,
are those
we're going to be
ranges?
data dependent. We're going to see how the numbers come in, and unemployment is obviously an important factor we'll look at.
Thank you for your indulgence.
Thank you, Senator Kennedy. Senator Van Hollen, Maryland's recognized.
Thank you, Mr. Chairman. Thank all of you for your service and your testimony here today. Vice Chair Barr, I want to start with you on FedNow. I've been a big proponent of moving to a real-time payment system. As you know, our current lack of real-time payments costs millions of Americans billions of dollars, especially those living paycheck to paycheck. In fact, Aaron Klein over at Brookings did an estimate that said if the United States had implemented real-time payments when the Bank of England did back in 2007, Americans would have saved over $100 billion in overdraft, check cashing, and other fees. And those are mostly Americans living paycheck to paycheck. So I understand from a speech you gave a little while ago, you estimate that the FedNow program will be live in May or to July of next year. Are we fully on track with that? Because there have been lots of delays. Are we fully on track? And what share of Americans that bank do you think will then have access at that point in time to real-time payments?
Thank you, Senator Van Hollen, and thank you for the support of the FedNow program. I do think FedNow is going to significantly improve the ability of banks to offer real-time services to customers. FedNow obviously will sit as the backbone behind what community banks and others decide to offer. That will take some time to flow through the system. We're on track to do that launch in the May to July period, but it will take time to build the number of institutions that are well positioned to offer the kinds of services that FedNow will then allow them to do. So ramp up time is going to take a while.
All right. Well, we look forward to a very concerted campaign by the Fed to make sure that banks are aware of their ability to sign up and help them sign up. As you all know, there's a lot of volatility in the global economy these days. The Dodd-Frank legislation authorizes FSOC to designate a financial market utility as a systemically important financial institution, a SIFI. Back in May, Secretary Yellen expressed concerns about some of the guidance issued under former Treasury Secretary Mnuchin that she believed unnecessarily limited FSOC's authority in this area. Do you have concerns about the guidance, the 2019 guidance that was issued under the Trump administration? And do you believe that this should be revisited? Let me put it more bluntly. If Secretary Yellen asked to repeal the 2019 guidance, would you support that as members of the FSOC? Maybe start with.
Yes.
Yes.
Senator, yes, I would be supportive.
Yes.
Yes, I think it would be useful to revisit the guidance and to make sure that it's working, that, again, we're evolving with circumstances. We're taking the risks that might come in the system in the future into account, and it would be useful to do it for that reason.
I appreciate that because I share your concerns about that guidance. Now, much has been said about cyber currencies and the collapse of FSX, and a lot have called for regulation. I've been a proponent of some regulation in this area, but there are those who make the case that regulation would actually normalize an area where there's inherent risk and create potentially the false impression that investment in these areas is safer than warranted. So there's a threshold question about regulation here. I'd be interested very quickly in each of your ideas. Regulate, and that can be any form of regulation, or not regulate because that creates an impression that things may be safer than others by giving a federal government imprimatur.
Thank you for the question. So first and foremost, I have responsibility for the safety and soundness of the national banking system, so I'm always going to put that first. A lot depends on the devil. The devil's in the details. So a lot depends on the details of that regulation. I think there is a form of it which could perform its intended objective. I think there are going to be potentially forms that don't and that fall into the trap that you just laid out. So I think a lot really depends on what those details are.
Thank you.
Senator, I think in one way or another, regulation is going to have to be necessary for the activity. I think it's important to consider carefully how we approach that. Talking about the crypto activity, almost all of it now is really investment and trading activity. So in the first instance, it seems to me it falls to the market regulators, the SEC and the CFTC. There is some interest, limited interest in the banking sector. And to the extent there is interest among banks, that will fall to us. As a general matter, I think we have authorities now to deal with the safety and soundness and consumer protection risks of bank engagement with crypto activities. I do think the stablecoin issue is a bit more complicated, and we do have existing authorities. That's an area where there may be a case for considering legislation, but I think more thought needs to be given there.
Thank you.
I'll agree with regulation is needed in this area, sort of building on what the acting comptroller said. The devil's in the details. An important detail for me would be transparency. Having lived through the financial crisis of 2008, I really impressed upon me the need for better transparency in our financial markets.
Thank you.
I would similarly suggest that the market regulators are the sort of first place to start in this space. They have existing authorities. We want to make sure those are fully utilized. Some of the activity that was going on in this space was purporting to go on in a way that was designed to evade supervision and regulation. I think we've seen the enormous human costs of that kind of activity, the investors and consumers who are so badly hurt by the recent events in the crypto space. In the banking sphere, just to reiterate what Director Gruenberg said, we do have the authorities we need in the banking space to get the job done in banking. And lastly, I do think there's quite an important need for developing a prudential framework for stablecoins with strong federal approval and supervision and regulation and enforcement.
Thank you. Thank you all. Thank you.
Thank you, Senator Hagerty. Tennessee is recognized.
Thank you, Chairman Brown, Ranking Member Toomey, and thanks to all of our panelists for being here today. I want to follow up on the line of questions that my colleagues have brought up, particularly around the astonishing set of events that led to the collapse of FTX last week. I think a number of people are calling for this incident to be a rationale or a reason to call the cryptocurrency regime nothing but a Ponzi scheme, that we should regulate it very swiftly, put heavy-handed regulations in place to deal with it. Several of you seem to agree that regulation is appropriate, but I want to acknowledge that some of the blame for this catastrophe has got to be placed on lawmakers here in the United States, and it shouldn't go unaddressed. The fact of the matter is that crypto, much like all of finance, isn't beholden to a specific country or a specific legal system. And by not acting And by failing to provide legal clarity here in the United States, Congress only incentivizes activity to migrate outside of our country's borders. Further, it's important to recognize that whatever happened with a bad actor running a centralized exchange and defrauding customers, that had nothing to do with the technology underpinning crypto itself. We shouldn't take the wrong message from what happened last week. No amount of poorly considered knee-jerk overregulation here in the U.S. would have prevented a foreign domiciled company like FTX from doing what it did. Instead, we should focus on accelerated but thoughtful efforts to provide clear incentives for companies to domicile here under laws that would prevent the billions of dollars of losses like those just incurred by FTX's unsuspecting customers. So, Acting Comptroller Sue, I'd like to come to you. Last month, you said in a speech that you were also concerned about the lack of clarity in crypto regulation here in the United States. Do you agree that with a clear regulatory construct in America, more cryptocurrency companies would be encouraged to operate here rather than offshore, where regulatory frameworks are obviously inadequate to prevent large-scale fraud?
It could. I'm more concerned, though, there are some basic foundational elements of the cryptocurrency technology and the industry which are not sound currently. And so regardless of the regulation, there are some issues with, for instance, ownership is not clear. And so if you don't have clarity about what you own, then a market where property rights are unclear is a market built on sand. Those issues are outside of any kind of regulatory discussion, and those are currently, the state of the crypto industry is not mature. I think that's a factor that has to be taken into account as we kind of work through what to do next. Yeah,
from my view, the maturity of our markets, though, and our regulatory system is much stronger than some of the markets where these companies are domiciled right now. And our view, if I understand all of you sharing a view that regulation is appropriate, is that an appropriate level of regulation that would give clarity and would help us deal with this would be more appropriate happening here onshore than, again, pushing this overseas.
Well, at least speaking as a bank regulator, to the extent that the activity takes place in the national banking system, it has to be safe, sound, and fair. People need to understand that, and we need to make sure that we maintain that level, that standard for the activity.
Agreed, and look forward to continue working with you toward that end. Vice Chairman Barr, can I turn to you for a moment, please? The Fed's own stress test results and financial stability reports recognize the strength of the U.S. banking system, not to mention the fact that our banks just supported our economy through the pandemic. And yet it seems that you're planning to layer yet more costly reforms on our banking system just as the U.S. navigates a recession and as the Fed fights the highest inflation that we've seen in generations. Part of this plan appears to be by raising capital requirements on mid-sized banks with a heightened leverage requirement. Under current market conditions, these requirements seem inconsistent with S21-55 and the statutory mandate for capital requirements to be countercyclical. So my question for you, Vice Chairman Barr, why is the Fed reversing course now and considering punitive new leverage and capital requirements for regional banks that could impede their ability to support the economy? Wouldn't you agree that raising capital requirements now is not countercyclical?
Thank you, Senator. We're undertaking a holistic review of capital requirements for firms. That includes issues about the globally systemically important bank surcharge, the countercyclical capital buffer, the enhanced supplementary leverage ratio, stress testing, and the like, to make sure that the capital rules are fitting well together. We're not trying to design a capital system for tomorrow morning. We're trying to think about what the capital rules should be over the cycle. So that involves, if we change the rules, undergoing a proposal and then a final rule and then an implementation period. And
just for clarity, I'm running out of time. I just want to ask this and make it clear. Would increasing capital requirements right now in the environment that we're in, amidst a recession, be pro-cyclical or counter-cyclical?
Well, Senator, in technical terms, there's not a recession right now. We are in a slower period of economic growth.
If you ask the people of Tennessee, I can tell you we're in very tough times. Is this the time to be following the rule of law and have our requirements be counter-cyclical? Or do you want to accelerate the process and push us further into recession?
As I said, I think it's important that we have capital rules that are good for the whole cycle, and that's the approach that I'm trying to take.
Well, I certainly hope that you will take strong note of the fact that I'm concerned about any move that might be pro-cyclical in a situation that we're heading into a recession, which I believe we are. Thank you. Thank you, Mr. Chairman.
Thank you. Senator Smith from Minnesota is recognized from her office.
Thank you, Mr. Chair, and thanks to all of our panelists for being with us today. I'd like to start out by asking a question about climate. So climate change can cause severe economic disruptions and risks to our economy. We see this in Minnesota and the impacts on agriculture and tourism and forestry, and Lord knows we've seen it in Florida, in places like Florida over this last fall. And our financial system is not immune from this risk and disruption. So banks are recognize this climate risk and are taking steps to manage it. And given the severity and the scope of the threats that we face, many of us think that we do need clear guidance from regulators on how to approach this problem. So I want to direct this first to Mr. Gruenberg and Mr. Su. Your agencies took a step forward by issuing draft principles to help larger banks manage climate-related risks. I realize that you received, as I understand it, thousands of comments in response, but I wonder if each of you could briefly tell us what is the general reception that you've gotten so far.
I think, Senator, if I may, I think the industry is receptive to guidance from the agencies in regard to managing the financial risks of climate change. I think the actions taken by the OCC and the FDIC were really an initial effort on our part to lay out a basic framework to incorporate the financial risks of climate change into the risk management framework that our institutions are familiar with. We have been engaging with the Federal Reserve as well, so I think it's our intention, and we believe this is important for the three agencies to act together so that the guidance is consistent across the banking system, and this would be a first step to offer guidance. And as you know, the focus of this initial guidance is on institutions with assets over $100 billion.
Right. Thank you. Mr. Su, could you respond as well and maybe let us know a bit about when you anticipate next steps?
Sure. So just to echo what Acting Chairman Gruenberg said, I think for the larger banks, this has been generally welcomed. And it's been welcomed because, especially those who are internationally active, they've been having to deal with some of this from abroad, which is how do we identify, measure, monitor, and manage risks from climate change. So I don't think that that's a new thing. I think for smaller banks, there's been a bit more of a different of kind of variation in responses, and this is something that I've been focused on, is trying to engage with community banks as to what the issues are and listening, making sure that we understand where they're coming from, what their concerns are with all of this. One pitch I try to make is not only are there risks to manage, there are opportunities. And there's this saying, the better a car's brakes, the faster you can safely drive the car. And I think that applies in spades here to climate risk, where some of these risks are novel, they're new, and if banks can get good at managing those, it also presents some opportunities for them. In terms of your timing question, just to echo something that Marty said, we're working together, and we're trying to prioritize making sure that the three agencies work together on that, and that's taking a little bit of time, but I'm pretty sure we'll get there in the not-too-distant future.
Thank you so much. And Mr. Barr, you have spoken about your intention to work with FDIC and OCC on guidance in this area. Would you care to comment on this and sort of how you see this working in conjunction with the scenario analysis exercise that the Fed is going to be doing next year?
Thank you, Senator. Yes, we intend to join with the FDIC and the OCC in issuing climate guidance with respect to firms that are over $100 billion in assets, the largest firms in the country. I think it will be helpful for them to have that guidance. So we expect to join the other agencies in doing that. And then, as you noted, we are also engaged with a pilot of climate scenario analysis that we're conducting with 6 of the globally systemically important banks. That will be conducted next year, and we expect to learn a lot from that exercise about how firms are managing the financial risks of climate change and how they are assessing those risks. So an important learning exercise for us in the coming year.
That's great. Well, thank you. I appreciate very much you all of your agencies working together on this. I think having clear input from banks of all the different sizes, from community banks to the large systemically important banks, is extremely important. And it sounds like what you're finding so far is highlighting what we already know, that banks appreciate this risk, that they want some good, clear rules of the road for how to work with it and how to manage it. And so I'm grateful for all of your work on this. Mr. Chair, I have another question on bank consolidation, but I'll pursue that with a question for the record. Thank you.
Thanks, Senator Smith. Senator Moran from Kansas is recognized.
Mr. Chairman, thank you. Thank you all for being here. Mr. Gruenberg, let me begin with you. I'm going to express in a polite way my dissatisfaction with the demise of the Office of Supervisory Appeals. Despite a multi-year effort by the FDIC to establish, fund, staff, and operationalize the newly minted Office of Supervisory Appeals, which included a robust public comment process, you chose to dismantle this more independent supervisory appeal process just months after it became fully operational, and it was one of your first actions as acting chair. Moreover, you did so through a summary agenda vote without any substantive discussion or prior public notice, providing only a 30-day comment period after the effective date of its demise. How do you justify such an arbitrary waste of FDIC resources with a total disregard for process and transparency?
Thank you, Senator. This is an important issue, as you indicate. A law was passed in 1994 requiring all of our agencies to establish internal appeals processes to consider appeals by our regulated institutions to supervisory determinations. And shortly after the enactment of that law, the FDIC established a board-level committee, a Supervisory Appeals Review Committee, to consider appeals. It was a determination that at the end of the day, the appeals process is very important. Any bank that believes it has, that an examiner has made an inappropriate decision or a wrong decision should have the right to have that decision reviewed by an appropriate process. And I think the view of the FDIC from the time the requirement was established was that a board-level review, which is the highest authority within the agency, is an important matter for board accountability. At the end of the day, the board is responsible for the decisions of our supervisors. If there are issues raised in regard to a supervisory determination, that ultimately should rise to the level of a board review. You accurately indicate that a change was made and an Office of Supervisory Appeals was adopted, utilizing individuals who, from outside of the FDIC, did not necessarily have experience working at the FDIC, but they had supervisory experience of some kind to sit in judgment of these supervisory determinations. I think our view was that board-level accountability was frankly very important in this area, and the Office of Supervisory Appeals had not yet begun functioning. The Supervisory Appeals Review Committee, the board-level committee, had a long-standing history and experience, so we did set aside the Office of Supervisory Appeals and continued the operation of the board-level committee and then sought comment. We received quite a bit of thoughtful comment, and we've now issued a new request for comment, incorporating into the proposal some of the suggestions we received in the comments, including placing our ombudsman, who is a neutral party, as a non-voting member of the board-level committee, giving appealing institutions the right to get access to all of the memos and documents relating to the supervisory determination that they are appealing, and also the right to request a stay of the supervisory determination until the appeals process is completed. So it may not be fully satisfactory, but we've tried to take a balanced approach to this, Senator.
And do you place any importance upon, use the word neutral, I would use the word independent, but whatever that is there a value to having somebody independent or neutral compared to the board?
I think so, and that's why we added the ombudsman to the appeals committee, Senator.
Thank you for your answer. My second question is to the panel. The Federal Housing Finance Agency's tangible capital rules is inconsistent with the federal prudential regulators' capital rules for accessing advances from the Federal Home Loan Bank system. As this interest rate environment continues to escalate with more unrealized losses on typically high-quality treasuries and mortgage-backed securities expected, we will likely see an increasing number of, quote, well-capitalized institutions lose access to key sources of liquidity due to this disparity in the regulatory framework. Although FHFA is well aware of the issue, the default has been for affected Federal Home Loan Bank members to seek waivers in writing from their prudential regulators instead of what I would assume would be a far easier fix, aligning those capital rules. Do you have thoughts about the desire of aligning those capital rules is the first question, and in the absence of that, what's the process for a member institution seeking a waiver from each of your agencies? Mr. Gruenberg?
Thank you, Senator. It's an important issue. And this is an FHFA rule that we're dealing with. And FHFA has a requirement that if a bank has negative tangible equity under GAAP accounting, the bank is not allowed access to new Federal Home Bank loans. It can roll over existing loans, but it doesn't have access to new loans until it addresses its capital, its negative tangible equity position.
That's a different standard or rule than any of the folks, agencies sitting at the table.
The banks have regulatory capital in addition, and that regulatory capital does not count in the unrealized losses that result under, this gets pretty technical, as you know, under GAAP accounting puts it into a negative tangible equity position. So, but it is an underlying risk management issue for the institution if it has negative tangible equity under GAAP. So we are engaging with FHFA and the banking institutions as a threshold. We are looking at the banks addressing their risk management issue resulting from the unrealized losses on their balance sheet, and we'll see if we can work this through.
Thank you.
Are you suggesting you don't expect it to be a problem then for those banks to access federal home loan?
I think this is just, I'm speaking for myself, I think we're looking for the institutions to address the underlying issue, which is the unrealized losses and their negative capital position under GAAP in order to gain access to the home loan.
Let me then ask the question about...
last question, Senator Moran. You're way over, but go ahead.
I've said here from the beginning, Mr. Chairman, with you and the ranking member.
There's reward for that.
Thank you. Plus our longstanding friendship. Is there a process by which a waiver is obtainable from the prudential regulators, as the Federal Home Loan Bank system suggests? I didn't say that right, as FHFA suggests?
So for us, it's basically using the regular way supervisory process is the way to address that. Just to echo a point that Marty made, we also see this as a risk management, fundamentally a risk management issue, and the alignment question is really a question for FHFA to address.
And if I could just on a couple of things. First of all, like the OCC, we would look at it through the supervision process overall. I think it's important to remember, though, that when liquidity is provided by a Federal Home Loan Bank, there are assets pledged as collateral for that. and there is a super lien that attaches to that. So we, as a insurer of the deposits that are at credit unions, would be placed potentially, depending on what the asset was pledged, we could have a higher liquidation cost if the institution were to ultimately fail. I think that's even more important why Congress needs to move ahead with the agent-member relationship that we currently do with the corporate credit unions through the Central Liquidity Facility. It is a federal liquidity backstop, and that is another way to deal with this issue.
Thank you. Thank you, Senator Rand. Senator Ossoff, I believe, is the last questioner from his office from Georgia.
Thank you, Mr. Chairman, and thank you to our panelists for your service. Mr. Barr, first question for you, please. What do you assess to be the most significant threats to financial stability today?
Thank you, Senator. We're looking broadly across the financial sector to look at risks. I mentioned earlier in our hearing, we're looking at, in part, at the risks that we don't fully understand, risks in the non-bank financial sector. We're certainly exploring and analyzing the risk that's been going on in the crypto sector. We're, as always, attentive to risks abroad from the war in Ukraine, the situation in China, and looking at what's happening in interest rate risk and liquidity risk in the system as interest rates rise. And then as the economy is softening, we're attentive to credit risk, particularly with respect to commercial real estate and residential housing, which tend to be leading indicators of potential problems in other areas. So those are the kinds of risks we're looking at.
Thank you, Mr. Barr. How confident are you that federal regulators have adequate visibility into potential exposure in the non-traditional financial institutions to risks that could pose a threat systemically to financial stability? And where are the blind spots?
We have good insight into the regulated banking system. We have very good, sound information, not only about the banking system, but about the relationship of banks to other entities. Where we don't have as good information is what's going on in the non-bank sector. We have increased information more than we did a decade ago about what's happening in hedge funds. So that's an advance, but still more information would be useful in that space. We have very little visibility into institutions that are not directly connected to banks. So very little information, for example, about the risks of the kind that we saw recently in the crypto sector, where our visibility is much, much lower.
Secretary Yellen, Mr. Barr stated last month she was, quote, worried about a loss of adequate liquidity in the Treasury market. I've also queried the Fed chair about this. Do you share her concerns, and can you characterize them, please?
Thank you. I do think that we're seeing a higher volatility in Treasury markets and in many other markets that is associated with the period of rising interest rates and economic uncertainty, both in the United States and globally. And with that increased volatility has come a reduction in liquidity of the type that you would expect given the volatility in the market. So, we're watching it very closely, as always, and it's something we're attentive to in thinking about the risks that lie ahead.
Appreciate that. Attentive to it. Are you worried about it? Secretary Yellen said she was worried about a loss of adequate liquidity in the Treasury market. Others have characterized this as a potential threat to financial stability. Do you have a different view, sir?
Well, I would say, as always, we're attentive to issues that might arise throughout the financial sector, including in Treasury markets. I think it's appropriate to be attentive to it, and we're attentive to it.
Thank you. Mr. Gruenberg, I'd like to ask you the same question, please. What do you assess to be the most significant threats to financial stability?
I generally concur to the observations that Michael made. I do think the rising interest rate environment, and important to recognize that it's a global phenomenon, that it's not just the U.S. as a jurisdiction that sees rising rates, but other major jurisdictions as well. And so from both a national and international perspective, the potential financial stability risk there.
Yeah, Mr. Gruenberg, forgive me, my time's running on. I want to just frame this question as precisely as I can. Of course, there are threats to growth, and I'm really focused here on threats to financial stability. I think the most constructive follow-up I can ask you is, what do you think are the mechanisms of action or the forms of exposure that will translate higher rates potentially into destabilizing financial shocks? That'll be my last question.
Yeah, I think the other point that Michael made that I would concur with, and you raised it as well, I believe, Senator, is the non-bank financial sector and the potential leverage in that sector and the risks that can pose both for the risks of those institutions as well as their connectedness to the bank.
Yeah, who are the counterparties? Who are the counterparties for that leverage?
Well, and the counterparties may be banks, and we do not have as good a line of sight into the inner workings of the non-bank financial firms as we do with the banking institutions, and so that it's both the risk we know and the risk we don't know, and that I think really needs to be a focus of attention.
Thank you. I thank you for your testimony, and I yield back, Mr. Chairman.
Thank you, Senator Ossoff. Throughout today's testimony, we've heard over and over how these regulators, the four of you, are protecting Main Street, watching out for risks facing our nation, no matter how small or large. We've heard a lot of concern about crypto risks today, a reversal from Trump regulators who let crypto run wild, as you all recognize. My Democratic colleagues and I warned of the risks to consumers and investors, have been for months and months and months, years in some cases. I'm confident our witnesses today will continue to watch out for those risks to protect people and communities, not protect Wall Street like we've seen in past years. Thank the four of you for being here, for providing testimony. For senators who wish to submit questions, for the record, they're due 1 week from today, Tuesday, the 22nd of November. To the witnesses, you have 45 days from receipt to respond to those questions. Thank you again. The hearing is adjourned.